Hi guys, thanks for joining me. Now, in this lesson we're going to take a look at what the major considerations are regarding the choice of exchange rate regimes. We're going to compare both LEDCs and MEDCs and the factors that they will really think about when it comes down to actually choosing which exchange rate to go for. Okay, so let's take a look at some of the things that LEDCs are likely to prioritise when it comes to choice of exchange rate. So first up, the notion of price stability. The fact that often cost-push inflation can be a real problem within LEDCs, and you can often have very, very high levels of inflation because of a fluctuating or volatile exchange rate. Now, as your exchange rate depreciates, of course, that means you've got weak pound, imports dear, exports cheap. But because your imports become very, very dear, then it means that there really can be a big rise in your cost push inflation. So therefore, as a direct consequence of that, it means that LEDCs do want to maintain some degree of price stability there to help manage that likely cost push inflation that can really damage consumer purchasing power in LEDCs, and that can really threaten things such as not just relative poverty but also absolute poverty. So maintaining price stability is also very important. It's also about developing policy credibility as well. So within LEDCs who may have begun to actually integrate themselves into the global financial system, they want to actually become renowned for the credibility with which they manage their economy. So this includes both the political institutions as well as the monetary authorities within the economy. So both areas are likely to require a lot of discipline in the way in which they actually operate. And this really can be a problem initially because international investors won't necessarily perceive that such LEDCs do really have good policy credibility. And again, a fixed or pegged exchange rate regime says this is what we are going to do. It ties the hands of monetary authorities. It means that they cannot just print currency, they cannot just increase interest rates because they forego that independent monetary policy unless they are using capital controls in the way in which China has, for instance. So it does tie the hands of policymakers there, and that starts to build confidence within the international community. Thirdly, consideration of main trading partners. So if a given country trades oil, perhaps it's again likely to want to actually maintain a fixed exchange rate in relation to dollars because oil is a dollar denominated currency. Now, other countries may choose to actually fix their exchange rates to a range of different, or a basket of different currencies that are the dominant trading partners within which they work. Okay, once again, that can help to manage the sort of volatility that could otherwise really threaten immature or underdeveloped export sectors. Then we've got the degree of maturity over the financial sector. Now, this was a big problem when it came to the Asian financial crisis, that suddenly the capital account was liberalised, allowing lots of foreign money to come into those Southeast Asian countries such as South Korea, Thailand, Indonesia and Malaysia. Now, as a direct consequence of that, it meant that the financial sector could not manage such large inflows of cash, and it went into a lot of speculative investments. And of course, the actual marginal efficiency of capital diminishes the more investment that is undertaken. And so as that happens, it means the actual returns will diminish, then you're left with all sorts of bad investments which are non-performing loans and turn into bad loans, and then that money can't be taken back. So you need to have some regulation, some restrictions, and a lot of training and investment taking place to ensure that your financial sector isn't going to take on huge risks which could potentially damage your economy. So this is a big consideration for LEDCs following that big financial crisis in Southeast Asia in 1997. Okay, so as a direct result of that, many countries will look at their financial sector and think about managing it overall. So anyway, the key takeaway here really is that given these key areas, then we can see that LEDCs are likely to go for fixed exchange rates really. They are likely to opt for fixed exchange rates because of the security and stability that they offer. But of course that can pose various problems, which we will look at. Okay, now when it comes to MEDCs, well, what do MEDCs focus on? Well, they like this notion of self-correction for any current account deficits. Okay, the fact that the exchange rate can fluctuate to a degree means that their exports can become cheaper if their currency weakens in response to a current account deficit, and that can help self-correct, as even though that can be quite unlikely in practice. Take the UK's current account deficit as an example there. Okay, but anyway, they do like that notion. MEDCs also want freedom in monetary policy. They rank this very highly. And because of that, they do tend to opt for floating exchange rates. Okay, so that floating exchange rate, of course, will go up and go down according to what monetary policy is actually in action within given economies. Okay, MEDCs may benefit from greater long-term investment as well, as opposed to LEDCs, which may receive a lot of speculative short-term hot money flows, and that can really place big problems, particularly in relation to this point that we made. But in MEDCs, the investment is more likely to be longer term because they have a proven track record of their integration within the global financial system. We know that they have political credibility. We know that the monetary policy committee of those countries is likely to have good credibility. So as a direct consequence, a lot of the financing of the UK's current account deficit comes through property investments, as well as inward FDI into what were British companies, or other investments like, for instance, Nissan plants, Honda plants, and so on. Okay. There's also less need to actually retain forex reserves or foreign exchange reserves, of course, and there is a big opportunity cost in maintaining such reserves. Okay, so those really are the key points here. It is worth noting that MEDCs, yes, they will tend to go for floating exchange rates, but a lot of them use certainly an element of dirty floating principles. And if you think about quantitative easing and the way in which that has been used, it's also argued that has been used to weaken exchange rates. So it's not about pure floating necessarily. Okay guys, I hope that was useful. Thanks ever so much. See ya.